Right, good afternoon, everybody, and welcome to another TFN webinar. This one is being delivered in partnership with Brewin Dolphin. They are partners of ours, whom we are currently running a project called The Board You Can't Afford, which is set up for not just startup businesses, but also established businesses that are looking to find support, funding, or in some cases just feedback on what they can do to take their business to another level and grow. So as part of that, we've decided that we'd like to run this webinar, which is all about what you can do to bring on funding. And we have a very esteemed speaker here today, James Merryweather. Thank you for your time. You're welcome. My name's Dale, by the way, in case you think, who's this guy waffling on. You're only going to see me for a few minutes. I'm the director of the Fashion Network. Like I say, we'll be doing this, and we'll be doing other seminars like this, all dedicated to trying to help you guys find investment and funding. It's going to run, James is going to do a quick 15-20 minutes presentation, and hopefully you'll be able to share some really useful insights for all you guys. And then Matt and James will have a bit of a fireside chat for the remaining 30-40 minutes. So if you have any questions, there are a couple of ways you can ask the questions. You can either ask the questions in the Q&A feature at the bottom or the chat feature, or you can actually stick your hand up and we can put your feed live. We probably, I don't know, Jane and Matt, we probably prefer to have questions in the chat box, I imagine, but
yeah, ideally I think that would be preferable.
Right, well, without further ado, I'm just going to hand over to you, Matt. So I'm going to disappear from the screen, everybody. So I hope you find it all worthwhile and valuable. Any feedback, please leave that in the chat, or you're welcome to email or contact us on social media. Like I say, any feedback, good or bad, doesn't matter, let us know. So I'll leave you guys to it. So cheers.
Perfect. Thanks, Dale. Really appreciate it. For those of you who don't know me, my name's Matt Casson. I'm an investment manager at Brewin Dolphin. As Dale's already said, we've partnered together on this board you can't afford concept. We're trying to help companies. There's no other way of putting it. Most places will look for investment, but we're just trying to help companies in as many different areas as we can. And a lot of that comes from feedback from yourself. So as Dale says, if you've got anything you'd like to ask, or you'd like to help shape our webinar series going forward, then please do. I'm going to pass over to James now. James is going to do his presentation for however long it takes. We'll then have a nice chat, but I do want to keep this open. So if you have any questions, please just put them in the chat box, and I'll come back to them after James and I have completed. So over to you, James.
Perfect. Thanks Matt, and thanks Dale for the introduction. Yeah, so I'm going to just try and kind of talk people through and maybe give my insights, give some information about how the investment process generally works. I've asked the guys to rush me along. Should I start to waffle or ramble at any point? Let's hope that doesn't happen. So yes, so I'll just kind of take you through. Always happy to speak to people. Just do let me know if you've got any questions. We've got my contact details at the end. Anything you want me to kind of go back on during the presentation, or anything that we can talk further about, then please feel free to reach out to me. So this whole presentation is around what investors generally look for in startup opportunities. I am with a seed fund called KM Capital, so I kind of come at this from that perspective. So we take, we were launched back in 2017, just over 3 years ago now. The three gentlemen who you can see in the picture there, who are not me, are the kind of founding shareholders of our fund. These guys have got very complementary backgrounds, you would say, in kind of consumer-focused businesses spread across fashion, e-commerce, property, a couple of marketplace businesses, and our kind of source of funding and our experience is kind of backed by the family office of the founding family behind Boohoo.com. So we're based in Manchester in the UK. So a couple of the big businesses that we've been involved with: Boohoo.com, PrettyLittleThing.com, who I'm sure you're aware of, and one of my other colleagues was a big part of scaling up Betfair and Zoopla, two kind of big venture-backed success stories in the kind of early to mid 2000s onwards. So we like to invest in what is known in the industry, and we'll get to this as kind of a pre-seed or a seed round. And generally to us that means that we're investing in companies who are doing kind of no more than maybe $1 million a year in revenue, and our investment is in order to kind of take an equity stake in these businesses. And again, we'll get to what different investors might invest for and what their motives are. But generally, we invest for an equity stake in a business. So that's KM Capital, seed fund based out of Manchester. And I fit into that, having joined in 2018 as a sole employee of this fund's kind of come and take hold of it and manage it for its 3 founding shareholders who have various other businesses that they're still involved with. So previous to that, I was advising older, maturer businesses around raising debt and equity, taking each other over, selling parts of businesses, creating a forecast, creating financial models. So that was my kind of bread and butter. I came in, as I say, as the first person working on this fund, and just networking with people like, Matt and Dale, who might be working with companies who are raising finance, and just making sure people kind of know what we're about. So since I joined a couple of years ago now, I've kind of managed and led 16 of our latest investments across 14 different companies, with about 1.3 million invested from our first fund. On top of that, I kind of manage the existing portfolio of now 21 active companies that we've got, and just report to the 3 shareholders, report to our connected family office, just of how the companies are progressing. But I think it's very important, like to me personally, just to make the investment process a little more clear. I didn't when I joined this fund, I didn't really know the extent to which the kind of early stage investment world existed. I didn't really know how it worked. I didn't know how fundraising worked, and I found some of the terminology a bit hard to navigate. And now I'm in the role, and I know it really well. And of course, I'm not a master of it, but I know this world very well now, and I don't think it needs to kind of be as complicated as it is. So to that end, I've kind of outlined here the different kind of operators that you would get in this kind of investment world, and you can kind of split them across different growth stages, if you like. So at the very small end, you've got a kind of seed stage business, what is known as a seed stage business. You've got early stage businesses, you've got growth stage, later stage, and then companies who are kind of preparing themselves for exit. So these are quite changeable and arbitrary labels given to businesses at each stage, who are kind of bracketed into these different areas. You generally have a different source of finance for each stage. So as you can see here on the far left hand side, in the very, very early stages of a business, you're self-funding it, which is here. You may be getting money from sort of family and friends and fools, people call that stage. And then towards the top end here, your sources of finance are kind of public markets basically, or private equity. And depending on how much cash you need, each of these players can provide a different source, as you can see on the bottom there. The reason I set this up is because each of these kind of groups on here has a different motive and a different expectation. If you are to take funding from them, each of them has a different motive of why they are investing, and there's implications with how you would need to run your business should you decide to take finance from each of these sources, which we'll get to. Another quite nice kind of infographic on this here, the fundraising journey from a firm I'm connected to called Robot Mascot. Again, they're kind of identifying different providers of finance for each stage of business. So they would categorize these things. If you're a startup business, you're funded by your friends, family, angel investors, and small funds. When you're scaling up, you start to bring in more kind of institutional investors, and again, very important because these people have different kind of remits. And on this kind of classic scaling up journey, you also have like different labels applied to each stage of business. Generally, you have a very early stage round, a pre-seed or a seed round, they're known as, right down here in the early days. And that would be generally to kind of fund losses. That's when you're loss making, you're establishing yourself as a business. And then you kind of, the sort of classic VC journey, I guess, would be that you kind of continue to take on funds as you scale up and potentially become more profitable. And you might be raising money for growth rather than raising money to kind of fund your losses, as I've kind of said there. And this is kind of a textbook example of how a business might grow. Never works out like this in practice. Your different round, you can have a big round followed by a small round. You can have emergency fundraisers where the business for whatever reason becomes short of cash. So this is by no means a kind of bread and butter easy journey to go through, but I think it's important that you kind of understand these labels and the different sorts of people who would operate at these stages. But fundamentally, I think, as I've said, like investors expect to see different things at different stages of business, but at the earliest stages, these can be quite similar really. And I think there's a kind of a handful of things that any kind of early stage investor looks for. ourselves included, we operate at the early stage of a business. Most important, I think, by far would be who is running this business, what experiences do the team have, how are you an expert in your field, to what extent have you scaled up a business before? Not that any two businesses are the same, but there's certain bumps in the road that a lot of businesses will face, and it's a small bit of comfort for us if we're considering making an investment in a founding team that they've maybe been there and done this before. The market is very important. We'll get to why that is the case if you're going to kind of go on this fundraising journey a little bit later. But I think in order to be an attractive investment opportunity, you need to be operating in a big enough market. Very difficult. Like, you can be a great business in a small market, and I kind of make this point later, but that potentially doesn't really fit in with the investment model of angel investors and venture capital funds. They're looking for your kind of probability to turn your company into a really big business, and operating in a big market allows you, kind of gives you the potential to do that. And what I kind of term scalability here. So an important kind of feature of a business, when I'm potentially looking at making an investment in it, how kind of scalable is it? How long does it take a customer you have acquired to return your investment in acquiring them? How fixed is your cost base? How many more kind of overhead costs are you adding for each new customer you bring into the business? How capital intensive is your business, basically? So for us, these are kind of the three gateways, if you like. If there's a big gap in one of these, and this is all kind of subjective and down to our opinions, but if there's a big gap in any one of these, then it's really quite hard to get to the next set of tests, which I would outline here. So what's your competition like? To what extent is your business kind of doing something new and novel? How much competition is there in the area? So it seems to be seeing a lot of kind of people attempting to disrupt the kind of Rightmove and Zoopla model right now. A lot of that, and the old kind of venture capital trope is that something needs to be 10 times better than whatever the incumbents in that market are doing before you can really make a dent and create a big business in that space. So how different is the model or approach? In terms of your route to market, are you making sales yet? Who is your kind of end customer? So for KM Capital, given the businesses that we have scaled and supported in the past, we are useful to people who are selling to a wide consumer base. We're not so good for people who are trying to sell a product into government, for example, or into the NHS, something like that, because we don't know how to navigate that process, or we haven't navigated that process ourselves. So, what is your route to market, and does that fit with us? In terms of your momentum, what does your kind of growth curve seem to be like? Have you been slogging this out for the last 10 years and really struggling to get traction? That clearly is an indicator that potentially this is going to be a tough business to scale. In terms of your revenue model, what's your pricing strategy? Is it realistic? How does it scale? How does your pricing change as you acquire your next million customers compared to your first million? And then in terms of more fundamentally your financial model, how does your cash flow cycle work? I think what's difficult for a lot of product businesses is getting your supply chain right. Do you need to buy all of your stock and pay cash up front and store it in a big warehouse before you have even made a sale to your kind of end consumer through your kind of Shopify store or whatever that is? So it's important to kind of assess that, and if that works very much in your favor, if you're buying everything up front and then selling it, I think you'll always have certain financing problems which can be overcome with other kind of financing models, but that's another thing that we consider. And then in terms of a funding round itself, if you're raising a round of funding from an investor, how has the round progressed? Are you getting a lot of interest in this round, and are we a good strategic fit for your business? So are we the right type of investor who you feel like you should be working with? Very important, just readying your business for investment before you kind of go out and approach people. And this can be quite tough, I'd say, before you consider kind of going to equity investors in any way. You're going to have to get some skin in the game. You're going to have to invest some of your personal finances into this venture. If you approach an investor having not invested a penny of your own money into a company, it's quite difficult to convince an investor that you're a kind of good bet, and that's a difficult ask, really. I wouldn't have my own finances to go and start a business with. However, I've got to kind of assess a founder's commitment almost to a project by how much they might have invested themselves. And also, you don't want to kind of invite new shareholders into your business too early and have to give away too much of a stake beforehand. So yeah, I would just make sure that you have kind of figured out how much cash you might need to hit your next milestone, whether that's reaching a profit or a next investor. And I would advise kind of making a bit of a detailed shopping list of things that you might need to spend on to grow your business. So you would then maybe need to summarize that total list. It might look something like this. You might be spending money to acquire stock, do marketing, make hires, just give yourself some kind of breathing space and working capital. Let's say that's just short of £500,000 that you feel that you need. What you would then need to do is assume that an investor is going to expect, realistically, this is based on lots of data of actual funding rounds completed, they're going to expect to acquire between 15 and 20% of your business. So here you're kind of valuing your business somewhere in the range of, just short of 2 million to about 2.5 million. That means, your business is worth 1.8, got 450k of cash going in, which is very easy to value. And your post-money valuation will be known as kind of 2.25 million there, which means you've sold 20% of your business for that 450k. And again, these terms are things that you will see, as you kind of navigate a fundraising journey. So it's important to familiarize yourself with them. So once you've kind of arrived at your valuation based on your shopping list of different things that you need, have a think about, will investors agree with that? And we'll get to the sources of how you can benchmark your business against others. But I think you have to have a skeptical look at the business and say, is an external investor going to agree with me that my business is worth this? If it is, then great, you can start the next step, which is to go out and find investors. But if not, then why do you think that might be? And can you maybe stagger your fundraising? Can you afford to raise a bit less than that 450 up front, maybe half that, and kind of stagger things and reapproach investors at a later point when you can command a little bit of an increase in your valuation. So this is all part of kind of making your business ready for investment. And there's tons of resources out there that can help you do that. I've highlighted a couple there. So some of the kind of data that I've based these valuations on here is from a firm called Seed Legals, who are great kind of startup lawyers effectively, but I would Google them if you haven't already. And then a firm called Robot Mascot as well, who are great at kind of getting businesses investment ready. They're kind of a startup branding agency, if you like. So I really rate those guys. I think they're good. So going back to the different kind of stages of investment that you can go through. And again, initially you've got your self-funding, family, friends, and loans. You'll see this in the kind of jargon termed as the bootstrapping phase. All your funds are coming from close connections, family members, personal lending. At this point, you need to get your business going, get it off the ground, get some early adopters, and then just start to generate some kind of early consumer data to show that there's demand for your product and you can deliver it profitably. And you profitably long term, but I don't think you'll be profitable now, just because you're a very early stage business now. And then investors are interested in kind of the story and how you communicate the opportunity, how you kind of sell that and sell the vision that in 10 years time you're going to be, I don't know, as big as Uber or someone like that. You might at this point kind of be talking to kind of accelerators and incubators and company builders. If you've not come across these, they have a kind of application process and try and effectively just accelerate your business. So you apply to an accelerator. If you're admitted, they just give you a load of different, like a suite of business services. So some shared office space, some networking with other founders, some maybe financial resources, or if they're a bank that has an accelerator, some access to subsidized banking products, that kind of thing. If you go down this route and you want to kind of take resource or take funding from them, again, you're just continuing out demand for your product now. Maybe you're making sales, but maybe not. But then you will be kind of making some kind of progress. You will be growing. You might be making your first hires, and these people, when you apply to them, they want businesses with the ability to scale up and get big. Occasionally they're taking an equity stake in your business, which means they have a real vested interest in you kind of kicking it on and growing. And you should look for, like, if you're applying or thinking about applying with an accelerator or an incubator, you need to be looking at its reputation. You need to be speaking to people in your network and seeing what they think of it, because some are better than others. And from an investor point of view, there's some certain accelerators which I would look at and think these are a real great outfit. So there's a few on there who I've worked with in the past who refer very interesting investment opportunities to me. Next up, you might have angel investors or groups of angel investors. Essentially, these are high net worth people. They've probably sold a business of their own and then can reinvest capital into yours. You can reach out directly to these people through various means, various databases and LinkedIn and places like that. In order to secure some of these, you're going to be generating some kind of revenue, but not too much. And I recommend, people look for an angel investor who is specific to your industry, who knows your world. You're running a fashion business, find an exited fashion entrepreneur. And that's what they want as well. They want to be able to kind of bring something else to the party other than capital. And they also want financial return. So yeah, just find someone who kind of knows your industry, try and get references. This is a very long-term relationship. If you're inviting an angel investor into your business, this is like an 8, 9, 10-year relationship you're probably going to have. You need to try to find good people who you connect with, who share your values, who are patient, who have the same vision for the business as you and kind of buy into you. And you might have seen EIS and SEIS initiatives in the past. This is essentially the government's attempt to encourage funding into early stage businesses. It's a big tax break for wealthy people if they put their funds into startups. The government wants, the economy to innovate and produce, big, fast-growing tech companies who can be big employers and give us some kind of competitive advantage. So you need to understand these terms and kind of speak to an accountant or a lawyer of how you kind of secure this. And there's lots of different kind of angel groups, angel investors, angel marketplaces. I think we're going to talk about this a little bit later in the Q&A. But there's various different ways and various different kind of avenues you can tap into in terms of securing angel investment. Crowdfunding is key as your business grows. It's a route that many people take. There's a couple of platforms in the UK. The biggest two are Crowdcube and Seedrs. They'll let you, I could just silence Crowdcube, find an investment opportunity that's listed on there, stick £10 in. I've done it before. I've put £50 in. A business called 3 Words the other week. Let's see how that goes. And they're great for kind of consumer-focused businesses where you might have 1,000 retail investors into your business who then become kind of advocates and disciples, and they love your brand and love your business, etc. Oops. Let me just get back into that. So yeah, crowdfunding is an avenue that maybe when your business grows a little, you can kind of get to. Good examples of that, Crowdcube and Seedrs, platform you launch your business on there, set a valuation, let's see which retail investors kind of get on board. A big source of funding once your business reaches a certain stage is kind of venture capital. They identify companies who can grow big very fast, but understanding their model is key if you want to kind of get on this venture capital kind of scaling up journey. And I've kind of put it in these terms. So think about who venture capital's investors are in turn. So these will be institutional investors, pension funds or endowment funds, or just big institutional players. They have two options. They can invest in what they might think is kind of fairly predictable, safer investment vehicles. They'll have sophisticated teams of wealth managers and things like that who might be able to get, let's say they would like 12% a year for their investments. Now, if they invest that through what they deem as maybe safer vehicles than venture capital, they can turn that 100 million, increasing by 12% in 10 years into about 300 million quid. So that's, that's an amazing game for them. Now, if you want to do the same thing through venture capital, you would say, let's say you put £100 million into a VC fund. The VC will invest that over 4 years. They'll charge you a fee to do that. And this is quite simplified, some of the numbers here, but the kind of the point is very much a valid one. So the VC deducts some money in fees for the first years that it invests, and that's just to cover its costs, cover its overhead, to pay its staff, falling when they cease to invest. But they would still levy a fee. So straight off the bat, that big institutional investor's 100 million has turned into 86. The VC would probably split that pot into two to find brand new companies and make follow-on investments into what they deem as to be the fastest growing businesses. Continue to buy slightly more of that business as it grows. So you've now got only 43 million to invest. That's probably a low number. Realistically, there'll be more than 20, but let's say, for the sake of argument, there's about 20 companies in this portfolio. When you look at the returns and how this model works and what happens in practice, let's say conservatively a third of them go bust, 7 return their money to the fund. So they don't grow really. They just return money, and 3 give a small return. That's still only 47 million returned. And when you work the maths through, and I can send you the tedious Excel working behind this document if necessary, what it means is that the remaining 3 have to give a 40 times return. They have to grow 40 times in value in order to make up the remainder of that £311 million, which allows the VC to compete with the alternative for its investor. So the upshot of this lengthy example is that a VC looks at every business and asks, does it at least have the potential to be that ridiculous company that gives me a crazy return in very short order? So that's how fast your business needs to be kind of capable of growing in order to fit the VC model. So if you secure VC funding, you're in for what I describe here as a bit of a wild ride until the venture capital fund exits or sells its stake when your business is acquired, at some point by someone else. So here you need to start scaling up really quickly. The VC supports you with that, and they want alignment with their thesis. So they've sold their fund to their investors saying they are experts in e-commerce or medical tech or something like that. So you need to make sure if applying your business kind of fits that mold. And important to make the point here that none of these types of funding for everyone. Like any investor wants to make a kind of capital return on its investment, and that means you've got to kind of scale up very quickly and value your business, and that doesn't fit everyone. If you want to run a lifestyle business, this type of funding is not for you. Classic example that I've just pulled out here is Deliveroo. So Index and Hoxton invest, but Deliveroo then will be worth between $10 million and $20 million, and Amazon recently invested at a valuation of $4 billion. So that's a big return for its early investors. So that's the venture capital model. In practice, that's what they want to happen. So some common problems that I see on our fund, reasons that we might not invest in a business. Good business in a small market limits your ability to be that big returner. So again, a VC needs you to return the entire fund will have the potential to. Anything which makes that less likely makes things tough for you. Tough working capital cycle, so the time between paying for and selling stock, you could do with that being short. Make sure your working capital cycle is as efficient as possible. Holes in a management team, lack of technical skills is a common pitfall that we see, and a lack of fit between an investor and a startup. So we like consumer brands, we like e-commerce, we like marketplaces. You may be at a bit of a disadvantage if you apply to us and you're not in that bracket. But that doesn't mean you have a bad business. You just, you might want to apply for a different sort of funding, or just kind of run your business without these kind of funders. So valuation is quite hard to get right as well. You can't be too high or too low, or you'll put people off. But you need to just extend your network, canvas opinion, and benchmark against businesses on places like Crowdcube and Seeders. Be aware that the hit rate for investment is very, very low in the industry. For us, we've invested in 1.2% of people who've approached us in 2020, which is like a ludicrously low stat, but it's kind of market, the market rate. So do be aware that you need to have a really, really big network to kind of make this work. And an investor will expect a certain suite of documents probably to support an investment opportunity. And there's loads and loads of resources online as to how you can kind of build that investor deck. And, it's not a document that you want to complicate, but it's something that you need to make stand out and not too formulaic. So in terms of wrapping up, be careful not to give away, too much equity too early or too readily, or, to the wrong people. As I said there, don't give away too much of it. Don't give it to the wrong people. Be skeptical of anyone who wants to kind of make an investment in your business. Make sure you've kind of due diligence them properly and reference them. Just do your research, do loads of prep, loads of networking. You need a big network in order to kind of secure funding, given the hit rate that I mentioned before. And if you need cash from investors, don't go and ask for it when you've nearly run out. If you can avoid that, it kind of sets you off at a poor negotiating position from the word go. A couple of resources there that I've just added into, maybe for you to go ahead and Google, which I've found useful myself. And that just about wraps it up. I hope that was not too long, too short. But Matt, that's the end of the presentation.
Are
you with me, mate?
Yep, I'm just. There we go. Sorry about that. Many thanks, James. That was really informative. It's very nice to hear KM Capital's secrets. I'd just like to say though, before anyone sort of rushes to ask any questions, or if there's anything you think you've missed in that presentation, the slides will be coming round. Mm-hmm. They've been deliberately designed by James so that you can take them away. Mm-hmm. So what we're going to do now is I'm going to act almost as the investor, as the business owner, and James obviously is the investor. And I've got a lot of questions that I'm going to ask James. We want to keep this open, so you've got your chat there. Please, join in as and when you feel the need to do so. If there's any questions that are outstanding at the end, then we'll do our best to get back to you at a later time. So I'm going to start then, James, if it's okay. One of the things I picked up on straight away was, is whenever, I see, a new business, gets told and they're setting up, is they hear about this fundraising journey and the journey that people are going to go on. Now, I look at that and I think, oh, well, it's already set for me. Is every business going to go on that same path? And the second sort of point to this is, there's a lot of terms in there that, I come from a certain background. I'm, from a retail background.
Mm-hmm.
I've never had to deal with these terms: pre-seed, seed, Series A, Series B, Series C.
Yeah.
Where do I go? How do I find help?
Well, I think let me just whip back into my presentation here. There was a few there's a few kind of resources out there for sure. Like, for example, I've kind of, with their permission, taken this image from a branding agency called Robot Mascot. Let me just put that up, sorry. And these people can kind of advise you, and it's their remit to kind of help you get funded effectively. Some of the terminology, like, it's quite arbitrary, I guess. I think I've put that in there. I mean, these terms came about, your first round of funding was always your Series A, your second was your Series B, your third was your Series C, like really simple, right? But then as the industry got bigger and more capital was introduced into it, you almost needed more terms to kind of identify what size of business you were dealing with. And then you get these kind of pre-seed and seed rounds. So they're not scientific labels to me, and they don't imply a certain volume of funds that you're trying to get into your business. They're just a kind of useful kind of finger in the air, like rule of thumb as to what you might expect. You'll get a business calls a funding round a Series A round and it raises $100 million, and you'll get another that does a Series B and it's 10. They're not kind of nailed on phrases, and your business doesn't have to follow this smooth upward trajectory either. I think depending on who your investors are, they expect, for a venture capital or an angel investor, venture capital fund or an angel investor to invest in your business, they expect that your plan is one day you want someone to come and buy this business off you. They want to, maybe a trade buyer, or you might want to list it on a public market, because that's how they kind of end up selling their shares. So I think if you want to take funding from someone like that, you have to be on the same page in that regard.
I suppose my next question leads on from that. Whenever I see an investor create a deck like this, we always have this exit phrase at the end. Mm-hmm. As I've set up my own business now. Is it important that I'm either thinking of exit or how far down the line do I need to be thinking, and what would you expect from me?
Probably at the point of deciding to take funding on from an external shareholder, you kind of, at that point, if you decide you need to take money from an external investor, you're also saying to them effectively that my job here is to grow this as an asset, grow it as an investment with a view to selling it within 7 or 8 years' time. So if you're at the point where you decide that investment is for you in this way, you're also saying that selling it in 7 or 8 times is your aim. And if you're not aligned on that, then you're probably going to create yourself some problems down the line. Either, if you decide that you don't want to sell the business later and you want to just run it and take a dividend from it, just run it as a lifestyle business, then you're going to end up with 20 or 30% of your business owned by people who are agitating for you to sell it, because how else do they sell their shares? Like, buying shares in an unquoted company is a very illiquid asset to hold. So you're kind of going to have a bit of disgruntlement on your shareholder register, and you then may need to buy them out. And you may be in a position where you can do that. You can, if you have a big profitable business that can support debt, you can put debt into the business to buy out those old shareholders, buy the shares back off them. But I think if you decide, I'm going to go and find some angel investors, the kind of implication from that is that you're also agreeing that your plan has now become that you're going to sell it in 5 or 6 years, or between, let's say, 6, 7, 8 years time. Does that make sense?
It does, because all you're doing is you're justifying to me that, is when I look for someone like you, I've got other people's considerations now. It's not just about what I want. It's not about a lifestyle business. It's not about getting it to 5 million. It's about what do we want? Mm-hmm. And that's a different approach to when it's just me on my own.
Yeah.
I suppose my next question then comes on to, in fact, let's just see what that question was. Sorry, we just had a question through. Are there any investors or funding areas that specialize in ethical businesses or not-for-profits?
I'd say not-for-profits is maybe a tougher one, and I would know less about that, because I mean, ultimately, you know, any investor now wants businesses they invest in to be kind of ethical and sustainable. Like, why wouldn't they? That's what consumers want. It's what everyone needs. Not-for-profit is a bit more difficult though, because again, when I'm talking about taking a stake in a business here, the idea is, you know, you multiply up that the value of that stake. So it's harder on a not-for-profit, because I don't think anyone else is going to kind of come in and acquire that business. But I think for businesses that are run for commercial gain, for a profit, and that are trying to grow, I think there's like ethical investors. There's people like Green Angel Syndicate, people like Mustard Seed, who are a small fund who like to back things with an impact and things with sustainability at their core. Yeah, there are people like that.
I mean, it kind of leads on to my next question, because on the next slide, you talk about there's 3 key areas that you're looking at from a business, you know, the team, the market, and the scalability.
Yeah.
Now, you know, is typically when I, you know, look at this is, you know, I'm trying to tick 3 boxes. From your point of view, you know, what's most important? Is there a mix of these that, you know, I need to, you know, particularly consider? You know, is you've put team and people first, and I don't know whether you've seen it, but in some of the slide decks I've seen, it's almost the last slide, because people aren't too, you know, is we're not naturally putting ourselves forward. I mean, what's your sort of thoughts on that?
The team, at the stage of investment we're making, the team is the most important. The team's experience, because we're looking at, you know, we might be looking at a set of investment papers, you know, an investment presentation, a pitch deck, or a funding model when a business is in its like first year of trading. And so many things can change, and, you know, businesses become different things, and there's pivots you've got to make. So at that very, very early stage, I know that the financial model I'm looking at, or the business plan I'm looking at, is not what the final business is going to be. You know, if it becomes successful in 5 or 6 years, it'll have probably changed a lot since, you know, until up to that point. It might be a completely different business now than it was then. There's an example, like within our own portfolio, we invested in a business. It was kind of like a fantasy football style app, with where you would like bet, like me and you would pick a 5-a-side team, football team, and I would bet you a £5 that mine would get more points than yours one week. Dribble Media it was called. And through various things that were happening in the kind of gambling industry, one of their big partners was acquired by somebody else, and it kind of killed their entire business model. So they pivoted, they changed that business and they rebuilt it as an esports first betting company. It's just like a Ladbrokes for esports gambling, for example.
Yeah.
Totally different from what they started out as, but they're one of the leading companies in our portfolio and have attracted investment from, you know, some really exciting funds after us. So I just think that is why the team is so important, the perceived ability to be able to pivot and, you know, deal with things that are thrown in your direction. For me, that is the most important thing.
Just on that, you know, as an investor, sorry, as a business owner myself, you know, I take it then from your point of view, you need me to be honest and understand where I'm lacking. And, you know, is it easier for you to invest in someone and say, look, I need the money because I'm missing this person. Look, the team's here, but there's someone missing. You know, is that honesty a helpful thing?
I think so, because I think that shows a kind of, I don't know what the right word is, you know, kind of self-awareness and emotional intelligence to understand where your blind spots are. And, you know, I potentially wouldn't invest in someone who kind of says, I'm good at selling, but I'm clueless at building. I'm rubbish at technology. I need to find someone like that. I think it's quite it's a skill that I don't think many people have, of trying to identify their own blind spots and being big enough and bold enough to say, I'm not, you know, it's my business, but I'm not good at this, and I want someone to come and help me with it. I think that's a big thing. I think certain business, you know, if someone's got an idea to kind of run a technology business and they're starting it, I think they need to have some kind of technical capability to understand what they can do. And I think for certain industries, you need to have that capability in the founding member, in my view. But I think that's a key skill to have, like the awareness to say where your blind spots are. It doesn't put me off.
Well, the obvious example, as we've seen in the news recently, is Gymshark, and, you know, understanding your limitations. You know, it's a business at the end of the day, and we all don't grow up knowing everything. You know, you know, pretty much every business owner, barring a few who've had it, will always have an accountant, for example. That's just, you know, a different arm to a team. what I'll do now, if it's okay, is Ismay, yes, we will get those to you, one way or another, maybe not in the chat, because we're in the middle of the conversation now. A question for you, James. Does KMN Capital invest overseas, or are you open to investing in other countries?
We have done. There's only one. So with 22 companies we've invested in, one's headquartered in the US, because we felt we could kind of get to grips with that as a jurisdiction. Like, we had people who we could lean on, who we know, who kind of helped us through that whole like legal framework and environment of, what a legal agreement for making an investment in an American business looks like, and we're able to kind of due diligence that for us. Other places, I'd say that would be more difficult. I think we know what a UK legal agreement looks like. We know how the market works. We know what investors expect. We know who the other players are, who we can, refer a business onto when it gets too big for us. But
the example they've actually used,
overseas.
James, sorry, just to interrupt, the example they've actually used is Ireland. So would Ireland?
Oh, Ireland, yeah, I would imagine that. I don't see any issues with that at all. No.
Yeah, okay.
Because I'd say, it's a jurisdiction that maybe I'm ignorant saying this, but I can't see it's loads different from England.
Okay, sorry, I'll come back to you in a bit, Christian. I'm just going to carry on with a few questions I've already got set up. On your next slide, the sort of next step, the questions that you're asking. So ignoring those three fundamentals that you expect in businesses to get past, COVID's changed the world. It's changing around us. We've got, increased automation, AI, VR. How important is this innovation to you? Are you still prepared to go and invest in, a normal industry, as pre-COVID, or is this digital age now a major consideration?
I think, like, fundamentally, a good, solid business is a good business, like, no matter what it does. I do think businesses that are underpinned by technology in some way, I would class as more like scalable, as I put on the previous slide. So any business we invest in has probably got a big element of tech to it. So, I don't think we'd invest I know we wouldn't invest in a retail store on a high street, for example. That we just wouldn't invest in something like that, because it's like a declining area. But I think all the kind of areas that you've mentioned, like AR and VR and things like that, are kind of growing markets. We have businesses come across my desk today in voice technology, kind of sits on top of things like Alexa and what the Google equivalent of that is, whose name escapes me. But that's really poor. I can't remember that off the top of my head. But I think we try to. It's hard. Like, if you're looking at an investment opportunity from our point of view, we're going to be investors for like 8 or 9 years probably. So you've got to kind of project your mind forward and say, well, how might this fit with the world in 8 or 9 years' time? And it's ridiculous. And people looked at Uber and said, like, stupid idea, that's not going to work. But certain industries you would look at and say, I don't think that's going to be that big in 8 or 9 years' time.
But that's also gives an indication to me as an owner of a business as to who I may be able to access. So if I've got a one of these non-digital, more standard industries, then obviously a VC who's looking for that 40 times, it's probably not for me. So it gives me an idea of the sort of investors that I should be looking for.
Yeah, definitely. And it's a two-way street. Definitely, like, you need to make sure you're inviting in the right type of mindset and the right investor into your business, as much as, sell yourself to them. It's not so much about advertising and pitching your business to other people. It should be a two-way street. It should be an investor kind of outlining to you why they are the right type of person who should be supporting you as well.
Just to finish off this slide then, before I go into some of the questions again, as you put their revenue model, financial model, funding round, I'm from a retail background. These are new concepts to me. People telling me I need them, people telling me how important they are. How do I go and get help in these areas? And once someone puts this spreadsheet in front of me and tells me, oh, look, you've got a nice financial model here. How do I know I've got a good financial model? And are there any particular things that you're going to tell me now as an investor that, need to be in it or are particularly relevant?
I do think that's difficult. And I think that's to do with your network and who you kind of have around you and advising you almost. I think it'd be impossible to know. There will be no answer to that question if you're just kind of sitting and running a business from your back bedroom, or even more than that. It's hard to do it in isolation. I think you need a good network. Again, I talked about accelerators before. They can be like a hub of 20 or 30 entrepreneurs all mucking in and helping each other out, and you can learn from each other in that kind of environment. You can contract with people like Seed Legals, who I mentioned earlier. or people like Robot Mascot, the kind of branding agency that I mentioned. There's people out there who know what good looks like because they've seen it a lot. And I mean, short of all that and kind of paying someone to do it, and I don't think people are really that expensive, like startup accountants. You can just get on those platforms again, like Crowdcube and Seeders, look around those, try and get yourself some access to the documentation that other companies have produced, and just get a feel for it. And that is probably what good looks like, people who are listed on platforms like that.
Okay, I've got a question here from Christiane. I'm sure you'll enjoy this one. She runs an online accessories brand, and she's finding it hard to get investment. Do you have any advice? As a lot of people are refusing to invest in certain industries because of the likes of Pretty Little Thing and Boohoo. As Kamani Capital, do you find that some industries are so dominated that you're not going to invest in them?
Yeah, and I think I mentioned some. So on my slide here, number 4, competition. I think it'll be hard to get an equity investor to back a business like that because the model is quite well trodden, it's quite well worn, and I think in order to get investment for a business like that, I think you've got to show how you're going to dislodge the incumbent way of working. You're going to have to be like a Depop or a Rent the Runway, someone who does something like fundamentally different. For me as a consumer, it probably cannot just be like another, e-commerce platform. It can't just be another kind of Shopify shop selling a different product. Probably, in order to get this type of investment, I think you've got to, I mentioned before, the VC, like the common VC phrase would be, how is this 10 times better than what's already out there? Because if you're not 10 times better, you're going to really struggle to dislodge the incumbent. So it's quite hard to succeed or get funding for what people might think as, I wouldn't say like just another PLT, but do you know what I mean? It's got to be kind of sufficiently different and sufficiently disruptive.
But from my point of view then, as a business owner, I suppose I then have to be more considerate as to who I'm targeting for investment. So straight away, if I don't think I'm going to be taking over Boohoo in that industry, and I've got smaller range, smaller target market, clearly VCs are out. Maybe what I need to do is find an angel investor who likes what I do, is relevant in the industry, who can provide some funding and start to grow me gradually. Because at the end of the day, profit's profit. And an investor who finds profit, we all want the 40, 100 times, initial investment, but there are a lot of people out there who just want a better return than they would normally get in investments or cash. Yeah,
and there's a lot of people who are investing their own funds. There are a lot of people who don't have to, I mentioned how a VC is funded. Ultimately, that's what dictates the alternative to a VC investor of investing in something else is what dictates they need such a ridiculous return from what they invest in. So people like this on the screen now, angel groups or angel syndicates are more people I would look for with that type of business. So local to me, for example, in Manchester here, you've got a firm called GC Angels. They have a small fund of their own that they invest through, but part of their commercial model is then connecting up a business into which they've invested with other high net worth individuals as part of their network. So they have a group, I don't know how many they have on their kind of mailing list, but they have various different kind of high net worth people who are interested in making investments into businesses like that. If GC Angels can connect them with that business, then it's part of their commercial model to kind of do that. They take a small percentage of any funds they introduce. So it's a nice service where everyone is quite aligned. GC Angels might make an investment. They might connect you with a relevant angel investor who then puts X thousand pounds in a business. Everybody kind of wins out of that. So maybe for a business like that, I'd recommend kind of going more down this route.
Yeah, thank you for that. What I'm going to do now is I'm going to touch on a few of the areas, we sort of talked about. And the first sort of says, I've set up my business today, is you wanted to see that, I'm pot committed as well, essentially, that I've got some skin in the game.
Yeah.
Does it matter how much I'm putting in? Or do you think it's relative to the worth? And how long do I need to? Because if I've tried doing it for 5 years on my own and failed, maybe the business isn't going to work. Equally, if I've done it for 5 weeks and just thought, I'm going to get some money off someone, what's the balancing act for me as as someone looking for investment in terms of self-funding?
Yeah, well, I think in terms of if you've been going for a long period of time, 5 or 6, 7 years, like there's businesses that we've had a good long chat with who have almost kind of gone on that journey, but with them, there's maybe there's something that's happened which has become kind of transformative to that business. So Zoom is obviously a majorly established business, and Zoom is a bad example probably to use here, but imagine a business that had been plodding along for 6 or 7 years, which was like Zoom, and then COVID comes about, and suddenly that's a different proposition. It doesn't matter that it's taken 7 years to get to where it's got, which isn't that far. The world is a different place now. Like COVID's an extreme example, but there needs to be something that's happened, which means it's on a fundamentally different kind of path right now. So that covers, if you've been running for a number of years. And then in terms of your own finances, I don't think there's not like a limit of what you need to put in, but I'd say it's a tough sell if maybe you've only put a couple of grand into a business which you are now valuing at, £1 million.
Equally, if I don't have money, but I'm a grafter, I'm working, is there a compensation factor that,
Yeah, we spoke to somebody, I spoke to somebody just today who maybe could put in for me, it would be a huge amount of my money to put into a business, but for some of the businesses we speak to, it wasn't a huge amount of investment that business has had, but she talked us through her CV and her previous roles that she had and the pay cut. Well, she wasn't getting paid now because she was working on this startup and she was foregoing a 200 grand a year salary to run this business. So I'm thinking like that is, a solid investment that, your time for 6 months is worth, the opportunity cost to you is massive. So there is that. There's also kind of company builders actually, which I've not really touched on in too much depth here. So, the Startup Factory in Manchester, for example, is a good one here. I could approach them with a bit of an idea, no technical ability to code it up and create a product. If they rate me as, they rate the idea and they rate me, they will build that product for me. So I've got my tech built for no fee, but they would maybe take a certain percentage of my business. There's company builders like that. There's another one in Liverpool called We Are Nova. You apply to We Are Nova, or there's others like Antler is one in London. Entrepreneur First is held out as like the biggest and best one. You apply to that either, with or without an idea, but just because you feel like you've, got something to add, you apply to that and they take a big stake in your business to kind of seed it for you. They give you 100 grand to build something with and pay your salary for a bit. And then you hopefully, and then so they own about 10% of that business or maybe more. But hopefully for them, it pays off because you go and grow something massive out of it. So there are kind of company builders who will invest day one.
I suppose that sort of answers part of my next question is we're on this accelerators, incubators slide. They're very popular now. You can't walk around Manchester Town Centre without being within 100 yards of one. Yeah. Do I need one? And how do I know which one to pick? Because you can pretty much, on your hand, you can name 5 banks straight away that'll have one in Spinningfields, for example. Yeah. How do I know which one I want?
It kind of like depends what you think your blind spots. So I was a business like, do you need one? I'd say no. When I talk to founders, generally, almost all of them would say, I like the fact that I was in a shared workspace with 20 other people at a similar stage of business that I was. One's running a fashion brand, one's running a property portal, one's running, a forecasting business. Like none of them are the same, but each of them has sort of like similar broad problems or things that they need to get good at in the background. So it's more like the networking with like-minded people that you would get in an accelerator. Short of that, I think different ones are well, there's some that are kind of sector specific. So the Founders Factory on there, for example, has like a health and beauty tech. It has like an entertainment arm to it. So if you're a business roughly in that space, they have like sector expertise for you. Even some of their investors are big corporates in that space. For others, it might be connections to investors. So I think you've just got to do your homework and read up as much as you can about an accelerator and think in what way is this the right partner for me to get to the next level? Like Techstars, every single investor in the world, I would imagine, they're global, they're massive, they're huge. So if I had a business and I really had started to build something and I wanted investor connections, I'd apply to them.
Okay, thanks for that. We've kind of covered this one. I just want to quickly ask you one thing. When people talk about angel investment, you've listed a load of places people can go, but sometimes people don't want to go down direct routes. In pretty much every business, people are after HNWs, high net worth individuals. What's the benefit of an angel investor? And you discussed one way going through companies. What's the benefit of going through a company as opposed to just getting someone direct?
Well, these people are kind of, there's no database of individuals you can go to. It's kind of, who do you know? I think there's a business that we made an investment in, and they were telling us the story of how they got the first investment. And I think they scoured LinkedIn or scraped LinkedIn, and anyone who had angel investor anywhere in their LinkedIn profile was maybe about 100 of them. And they sent a private message to each, just a blank message, this is what we're doing. I'm not suggesting everybody go out and do that, but this is like the sorts of things that you would have to do to engage these people individually.
It's competitive, isn't it? There's only so many of them.
Yeah, and they don't put their hand up and advertise themselves. It's the same as family offices. People talk about family offices, but there's no like repository of family offices you can just write to. So I think if you go through a company, like I was talking about these guys before, like GC Angels, Startup Funding Club, Q Ventures, they already have a community of people who have expressed an interest in investing in early stage businesses. That is about as good as you're ever going to get in terms of people with access to this kind of deal. And then ultimately, if your business is growing quickly and it's profitable and it seems a good prospect, people will probably come to you anyway. It's an easier set, it's an easier sell if you're kind of doing well. And that is like fundamental to any of this. Your business needs to be doing well and growing. And that is the most important thing, making sure your business looks after itself.
I'm just going to rush you now with two quick questions because we're running out of time. But you mentioned crowdfunding. Is there a minimum? Is there a maximum?
No, there's no minimum or maximum. But I'd say, let's use Brewdog, for example. It already had like millions and millions of customers who loved it, real advocates for the brand. So they just fly off the shelf. Like Monzo is another one like that. Yeah. There's no minimum or maximum. There's companies that can raise 100 grand on there. You need some kind of prior backing, especially if you're a small business, because you see this like progress bar here. It's hard hitting Crowdcube with no commitments to get interest from members of the public. You need to have some kind of prior backing before you get on there.
Just as an extension to that, if I'm own my business and I go through crowdfunding, I don't have to deal with that says 15, 30 investors. Yeah. I just deal with Crowdcube as an entity.
Pretty much. I think there's different options you can use here, but this classic, like Brewdog won't be dealing with 1,500. They'll be dealing with Crowdcube nominees, LLP, probably. If you go on Company's House and look at their investors, those 1,500 people, their funds go into a Crowdcube pot. Crowdcube invests it, and Crowdcube kind of manages, the voting decisions and anything around compliance that shareholders need to do. Crowdcube manage it.
Well, I mean, we're actually out of time now. I've not seen any more questions, so apologies if there are that have gone through. As I say, it's absolutely fantastic for Dale to have sorted today out for us, and James, for sharing Kamani's secrets on your own time. As I say, for anybody who has any follow-ups, you can contact James, myself, or Dale, or the Fashion Network via LinkedIn, or I think James's details at the bottom.
Either on there, yeah. Feel free to contact me. I hope it's been helpful.
And as I say, Dale and I are hoping to put on a series of similar sorts of events. This is the first, but as we can tell you what we think you need, it's just as important that you come to us and let us know what you think may be of help. We're ultimately trying to help businesses at what is a very, complex time in the market. So, please get in touch with us. Please tell us where what problems you're having, and if we can help you in any way, we will. So, I think we're gonna close the webinar there. But thanks, and I look forward to seeing you at the next one. Bye, guys.
Thanks, guys. Thanks, everyone. Bye.